My main focus point has to do with the Fed and its challenges it is facing here. We have the Fed meeting coming up on Wednesday. We all know that. But we are entering a different period than the last time they met. And that was, I believe, the end of January. Now we have ongoing tariff negotiations. We have government spending likely being cut, job layoffs from the government. And this has all hit consumer and business confidence in a big way. And that's all going to weigh on the economy and likely economic projections for the Fed. Now, historically, this type of environment of elevated inflation and weakening economic growth is called stagflation. And stagflation is really something nobody wants. If you're a consumer or a business, you don't want that. And if you're the Fed, you don't want that because you don't know which way to go. Do you continue to fight inflation, keep rates high, and do nothing about the decelerating economy? Or do you flip and say, no big deal on the inflation front. We are going to support the economy. We are going to support asset markets by providing liquidity because that is more important. Now, which way do I think they'll land? Probably the latter. Why? Because of our debt. Now, one thing that's underappreciated with the Volcker era was that our debt to GDP ratio was at 30% in the early 80s. So when they took interest rates from single digits into the mid-teens on the 10-year, it didn't really impact the balance sheet of the government because there wasn't a lot of debt. Now it's the opposite. It's not 30% of GDP. It's near 130% of GDP. And you've seen this already with now the interest on government debt over $1 trillion. And so that is the backdrop that they're operating in. Now, inflation is challenging to get a hold of. Now, last time Trump did tariffs back in 2018-19, didn't really impact inflation. Why is that? Well, it was pretty narrow. It was mainly focused on a small subset of sectors, and even some of those sectors, there were loopholes, like steel and aluminum. And people weren't used to inflation. Now people are worried about inflation, and inflation becomes a self-fulfilling prophecy in many respects. Why? Because businesses and consumers expect higher prices. So what do? They buy earlier. They buy today versus down the line because they want to secure supply at a lower price. And then consumers, workers demand higher wages because they need to be able to keep up with this inflation. And it forces the companies, once again, to raise prices to offset those higher wages, higher input costs. And that's why it becomes self-fulfilling. Now, the latest University of Michigan Consumer Sentiment Survey showed the biggest increase in long-term inflation expectations since 1993. Now, that's just a survey. That's what we call soft data. The market still doesn't think inflation is running away. In fact, it's actually expectations in the bond market for inflation have actually dropped recently. And if you look at CPI, it actually fell from 3 to 2.8 last month. So, it's kind of a mixed bag on the inflation front, whether it's accelerating or not. But either way, it's above the Fed's target, 2%. So how does the Fed handle that? Are they okay with it? Do they wipe it off as, hey, this is tariff induced and we're going to support the economy? We're going to support asset markets. We're going to support the treasury market. And I think the simple answer to that is yeah, I do. I do think that's the direction that they go. Because their ultimate job is to make sure the treasury is solvent. If it's not solvent, what are we doing here, right? You don't have a country, you have a bankrupt country, and you're destroying the financial system because the treasury is the backstop of the global financial system. And so while it's interesting to bat around this idea of which direction to go and head in, I really don't think it's a choice. Now, can they dance around it? Can they PR it to death? Yes. But there's political pressure really on both sides of the aisle. And I think they will come out on the side of supporting asset prices. So I think on Wednesday, they'll likely focus on the plan for winding down QT to keep reserves in the system so you don't have a financial crisis, as well as prognosticating about future rate cuts, which likely will commence in the next couple of months.